Welcome back to the SaaT System Channel, where we break down digital trends, emerging technologies, and smart strategies for building long-term wealth in a rapidly changing world. In our earlier episodes, we explained why 2026 marks the beginning of a new investment cycle, driven by liquidity easing, accelerating AI adoption, digital money, and tightening energy constraints. Today, we take that thesis one step further. This episode focuses on what assets benefit most from the 2026 shift and how aggressive investors can position capital across growth equities and digital assets while managing risk in a high-valuation, high-opportunity environment. This is not about chasing hype. It's about aligning capital with where earnings, adoption, and liquidity are compounding. Stick around until the end. We will wrap up with key portfolio ideas and why these trends could define the year ahead. As we enter 2026, AI remains the dominant growth engine in global markets. Analysts continue to forecast sustained double-digit earnings growth in AI-linked technology, massive data center and compute infrastructure build-outs, and hyperscaler capital expenditures reaching hundreds of billions of dollars. The semiconductor industry alone is projected to approach a $1 trillion annual revenue milestone, a historic inflection point. This environment favors aggressive equity allocation toward companies with dominant market share, high margins, and durable competitive moats. Let's start with the core AI and semiconductor leaders. We target 40 to 50% of our equity sleeve here. These companies sit at the heart of AI compute and production. First, NVIDIA, the undisputed AI chip leader. Analysts project continued dominance through new architectures, ecosystem lock-in, and massive free cash flow. Next, Broadcom, which focuses on custom AI accelerators and networking. Their strong hyperscaler partnerships and long-term ASIC growth are key advantages. Then there's TSMC, the manufacturing backbone of advanced AI chips, benefiting from surging demand and pricing power. Don't forget the toll collectors of the semiconductor supply chain, companies like Lam Research, KLA, and Cadence Design Systems. These are the equipment and design leaders essential to the whole process. Finally, consider analog devices for exposure to edge AI, connectivity, and industrial intelligence. Now, let's look at the broader AI enablers and hyperscalers. This group makes up about 20 to 30% of our equity allocation. These are the giants that monetize AI through cloud platforms and at incredible scale. Microsoft is a prime example. Its Azure growth and enterprise AI copilots remain, in our view, underappreciated by the market. Then you have Alphabet. Its search dominance, combined with deep AI integration, often makes it look undervalued relative to its long-term upside. And of course, Amazon. AWS remains foundational to AI deployment, with massive planned capital expenditures on the horizon. To round out our equity strategy, let's talk about high-growth equity diversifiers. We allocate 20 to 30% here. Beyond pure AI, these names add diversification without sacrificing growth potential. One to watch is SoFi Technologies, a fintech turnaround story, with profitability expected in 2026. Another is Mercado Libre, a dominant e-commerce and fintech platform across Latin America. We also see opportunities in select biotech exposure tied to powerful catalysts. Names like Vertex Pharmaceuticals and Eli Lilly are leading in gene therapies and metabolic treatments that have major developments expected around 2026. Before we move on, a few notes and risks on this equity strategy. It's wise to blend individual stocks with thematic ETFs for diversification. Also, limit your use of options or leverage to 10 or 20% of your capital. The bull cases here point to 50 to 100% or more in potential returns during strong AI capital expenditure cycles. But the key risk is that elevated valuations can lead to choppy markets. To navigate this, favor companies with strong pricing power, recurring revenue, and a proven discipline for execution. Now, let's shift to Section 2, cryptocurrency and digital assets, which are entering what we call the institutional era. As we move into 2026, Digital assets are increasingly shaped by institutional adoption, not just retail speculation. The major tailwinds are clear: the expansion of spot ETFs, improved regulatory clarity and market structure, and the rapid growth of real-world asset tokenization. For our crypto sleeve, we build a blue-chip digital foundation, making up 40 to 50% of our allocation. This starts with Bitcoin, the original digital store of value. Demand from ETFs continues to absorb a large share of new supply, with forecasts pointing toward new cycle highs. The other cornerstone is Ethereum, the backbone of DeFi and tokenization. Its Layer 2 scaling solutions and staking yields support long-term value capture and utility. Next up, high-upside growth tokens. We see this category taking up 30 to 40% of our crypto allocation. Solana is a standout here, with strong ecosystem growth across DeFi, gaming, and consumer apps, plus potential ETF catalysts on the horizon. Another huge area is real-world asset, or RWA, plays. Tokenized treasuries and credit products are expanding rapidly. Keep an eye on infrastructure providers like Ondo and Chainlink that are enabling this adoption. We're also watching AI-focused tokens. Decentralized AI networks, such as Bitensor, are attracting investors who want AI exposure beyond traditional equities. To complete the crypto portfolio, consider yield and utility positions for the remaining 10 to 20%. This includes payments-focused networks that are showing real adoption or have ETF potential. It also covers stablecoin and DeFi lending protocols tied to RWAs, which can target 5 to 15% yields. A few quick strategy notes and risks for crypto. Always use reputable platforms and consider staking your FNSO for additional yield. Avoid heavy leverage unless you are a highly experienced trader. The bull cases suggest 50 to 200% sector-wide upside, but remember that high volatility is part of the game. Your focus should be on utility, adoption, and institutional relevance, not just on fleeting narratives. So, to conclude, the 2026 shift is ultimately about productivity and infrastructure. Semiconductors and AI are driving earnings growth. Hyperscalers are monetizing that technology at scale. And digital assets are modernizing finance through institutions and tokenization. At SaaT System, we focus on these structural trends, positioning early in the cycle for compounding returns, not chasing late-stage momentum. Always do your own research. You can also explore AI-driven analysis at satsystem.com. This content is for informational purposes only and not financial advice. Investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. In the next episode, we'll dive into portfolio construction, risk frameworks, and rebalancing strategies for this liquidity-rich environment. Thanks for watching, and don't forget to subscribe.